This is going to sound political. I don't mean it to be political directly to you, but ultimately, is higher Treasury supply the price we've got to pay for the kind of things the White House is talking about?
Well, so I think higher Treasury supply is, what we're seeing when, obviously the Fed is running off its balance sheet. We're seeing really the impact from the previous few years when we saw a huge amount of support in terms of buying, and that's no longer the case. It is also, of course, as you mentioned, when you look at the fiscal deficit, I think that's an increasing concern among investors. I think that is something that they're aware of. We obviously had the Fitch's change in the rating, credit rating. And so I think, supply, demand, these things have all changed dramatically in terms of the dynamics around the Treasury market and the huge amount of supply that we are seeing and the lack of demand that we're now seeing. I mean, we've seen a completely different shift in dynamics. And so it's not a surprise, really, that you would see yields rise.
Marilyn, could you give us some detail on that? I know you and the team have been thinking about this and working on it. We've talked a lot about supply. How have the sources of demand changed in the Treasury market?
So we did have, obviously, a huge source of support from the Fed, and that is no longer the case. Now they're running off their balance sheet. So that was over 50% of support for the Treasury market that's no longer there. Then when you look at pension funds, life insurers, of course, the demand is still there, but I think it's probably slightly less now. We have already seen a big shift in terms of their asset allocation. And you also see, other investors such as money market funds, and they're obviously supporting it at the front end. But really, when you look at this demand in the belly of the curve or in the long end, when you look at foreign investment demand, for example, as well, the FX hedging costs are now very, very high. So you want to see a shift in the FX hedging costs to really see those investors coming back as well, or a change in the global growth environment. So there are a lot of different factors at play, but the support that was there for the Treasury market is just not there at the moment. And also when we're in this environment where we are seeing a lot of positive data continuing to come out of the US, we've seen a lot of market commentators, reassess their view of the US economy and the trajectory. And, many people are no longer, predicting a recession, and they now actually expect the economy to maybe moderate, but remain, relatively robust. And so there's no longer the supply or the demand for the supply when you're looking for, a safe haven, because, the economy is doing very well, and we're in a very, very different situation than we were 2 or 3 years ago, which was in itself unique and has created many of the factors that now contribute to this environment.
Well, let's talk about things pre-pandemic. You and I have been talking about this stuff for years, and the conversations, Marilyn, you and I used to have was that yields would stay low for longer than people thought they would. That was just the conversation that dominated things for much of the last decade. Have we truly entered this new regime where yields can stay higher for longer than people think they can?
I think yields can stay higher for longer. We've seen a huge shift in the dynamics, obviously, around inflation, which is persistently high. I mean, as you remember, when we came out of COVID, the narrative was that this was all temporary and, inflation would come down. That is not the case. And I think, we will continue to see inflation. I think we will see it moderate, and it will continue to moderate through the rest of this year. But it is going to remain higher for longer. And I think, therefore, we will see the Fed, may or may not, raise rates again. But I think when they pause, rates can stay higher for longer. The fact that the economy is also in pretty good shape, the labour market remains very, very tight. I think there are a huge confluence of different factors that mean that rates can actually stay higher for longer, and we are in a different regime to the one that we were in pre-pandemic. I think we've seen a wholesale reevaluation of the environment we're in now and the global dynamics. And we're seeing a lot of factors that contribute to that, including deglobalization, including ongoing geopolitical shifts. So I think there are a lot of different things that do contribute to that, and they're going to continue.